Welcome to the deep dive. We're jumping into something pretty unique today. We've got the official look back from a huge financial institution, Morgan Stanley, on 2020.
Yeah, and they don't pull any punches, calling it an extraordinary and unusual year. I mean, think about it. Global pandemic, massive economic disruption, and this huge focus on racial and social justice all hitting at once.
Exactly. So our mission here is to really unpack their shareholder letter from April 2021. How does a firm that big navigate all that chaos, deliver, believe it or not, record financial performance, and fundamentally change its strategy and core values?
Right. We're looking for the mechanism, how did crisis mode turn into this accelerated growth and change?
It's quite the story.
It really is. And, 2020 was like the ultimate stress test for the big banks. The question was, after the last crisis, did they actually build up enough capital, enough stability to support the real economy this time?
Unlike the previous decade, yeah.
Exactly. So we'll look at what they did right away, those immediate actions, but also the big structural shifts they made, like suspending buybacks early on. That gave them breathing room.
Okay, let's dive into that first part then. So that spring of 2020, things are looking, frankly, terrifying. Markets are plunging. What was the first big move they made to signal stability?
Well, it really came down to capital discipline almost immediately. They knew perception mattered just as much as reality. So in March 2020, Morgan Stanley and the other big U.S. banks, they voluntarily paused their share buybacks.
Voluntarily. So not because they had to initially.
Not initially, no. It was proactive. It was about saying, okay, let's keep maximum capital and liquidity right here, right now, when everyone else was scrambling.
Right. Conserve resources.
Yeah.
And that proactive step, that let them pivot to actually helping clients, didn't it?
Precisely. They could then turn around and support the companies getting hit the hardest. We see they raised, what was it, over $50 billion in capital?
$50 billion, yeah.
For sectors that were basically shut down overnight. Think airlines, cruise lines, travel companies. That was a critical injection of cash.
It showed them acting like that economic shock absorber they were sort of designed to be post-2008.
But it wasn't just the giant corporations. You have to remember the individual investors, too. Millions of people watching their retirement savings, gyrate wildly. Their wealth management side had to handle immense panic.
How do you even manage that kind of scale? I mean,
Like that.
keeping advisors from just burning out under the pressure.
Technology. They'd already invested heavily in their digital tools. So get this. Just in March 2020, when volatility was absolutely peaking,
Yeah.
their financial advisors sent out 6.6 million next best action communications.
Okay, next best action. What does that mean for someone listening? Sounds a bit jargony.
Fair point. It's actually pretty straightforward. It means using data to give personalized advice fast. Instead of just a generic markets crazy update, the system figures out for your specific portfolio and your goals, what's the one most important thing you should maybe consider doing right now?
Okay, like rebalancing or maybe looking at a specific sector.
Exactly. And it delivers that tailored suggestion instantly. So it's turning all that complex market noise into something actionable, customized, but delivered at massive scale.
Got it. So stabilizing the market externally, advising clients digitally. What about internally? Their own people must have been worried too. Huge economic uncertainty. What was the message to employees?
This, I think, was maybe the most significant cultural move they made that year. They made a very public, very strong commitment, no workforce reductions through 2020.
Wow, no layoffs during that period.
None. And crucially, this wasn't just for their high-paid bankers. They extended that promise to essential contract workers too, security guards, cafeteria staff, people often first on the chopping block.
That sends a massive signal, doesn't it? Confidence in their own stability, but also a huge investment in their culture.
Absolutely. And they could do it because their business continuity planning was solid. They'd already figured out how to shift almost everyone to remote work without missing a beat.
So the operational strength enabled the cultural promise.
Exactly. That underlying strength gave them the certainty to make those kinds of commitments.
Right, so that stability, financial and cultural, it sounds like it relied pretty heavily on their tech backbone. What specific investments really, paid off when trading volumes just went crazy?
Oh, the electronic trading platform was definitely the MVP there. They'd spent years making it robust, durable, and when the market went haywire, that platform just soaked up the pressure.
And haywire is putting it mildly. The numbers here are kind of staggering. Equity cash volumes peaked at 3 times the 2019 average.
3 times, and overall, the average daily volume for the whole year was 40% higher than 2019. That's just relentless pressure on the system.
40% higher on average. Wow.
It really highlights that shift, doesn't it? Away from the old shouting pits to these incredibly powerful, fast digital engines. But it wasn't just about executing trades. Their research teams were also pumping out insights, trying to make sense of the health crisis, the vaccine timelines.
So guiding clients through the market and the real-world science driving it,
Mm-hmm.
trying to connect those dots.
Okay, so they're handling peak volatility, they're integrating these massive acquisitions we'll get to. And yet, the bottom line, you mentioned record performance. How is that even possible? Record revenues of $48.2 billion, record net income of $11.0 billion.
It does seem counterintuitive, right, with the global economy hitting the brakes.
Okay.
But it points to the kind of business they've built, one that actually performs well in complex, volatile environments.
Hmm.
But the number to really zero in on, I think, is the ROTCE, return on average, tangible common equity.
ROTCE.
Right.
They hit 15.2%. Put that in context for us. Why is that particular number so important? Sure. ROTCE basically measures how well a bank uses its shareholders' money to make profit. Getting into double digits consistently is tough for big banks, especially in rough markets. Hitting 15.2% during 2020, that signals exceptional financial health.
Okay.
It shows their strategy, less risky trading for themselves, more focus on managing wealth and assets for others, really worked under pressure. It was battle-tested.
And they weren't just playing defense, they were on offense, too, with acquisitions. They closed the huge E-Trade deal and announced they were buying Eaton Vance, M&A, during a pandemic.
That seems risky. A huge potential distraction.
It seems risky, yeah, but it was clearly calculated. They must have believed the crisis, however severe, wouldn't last forever, and maybe valuations were attractive. They were playing the long game while managing the short-term chaos.
So, strategic opportunism. I think so. Closing E-Trade gave them this massive new channel to individual self-directed investors, and Eaton Vance seriously beefed up their investment management arm. These weren't small tweaks. They were fundamentally reshaping the business for the next decade, right in the middle of everything, setting up what they clearly see as a new growth phase.
Okay, let's shift gears a bit from the financial side to the cultural and sort of moral response. 2020 forced a lot of difficult conversations about systemic inequality. How did a giant firm like this translate that moment into actual lasting structural change, not just, statements?
This is where you see the pivot become really embedded, really permanent. They decided, it seems, that just talking about it wasn't enough. So in June 2020, they added a fifth core value to the company's official list: commit to diversity and inclusion.
Why is making it a core value such a big deal? Couldn't they just launch some D&I programs?
Because core values are different. They're meant to be non-negotiable. They get tied into everything: how executives are paid, who gets hired, who gets promoted. It was a formal way of saying, okay, representation, equity, this isn't just a nice to have under our existing value of do the right thing. This is a specific core responsibility we have to own.
It elevates it, puts teeth into it.
Exactly. It formalizes the commitment. And that commitment directly led to creating the Institute for Inclusion, which they launched that fall.
Modeled after their Institute for Sustainable Investing,
Yeah.
right?
That's right, which suggests they see D&I needing the same kind of serious, long-term, almost academic focus as something like climate change. The Institute has three main jobs, basically. Boost economic results in underserved communities, use philanthropy strategically to fight systemic bias, and drive their own internal D&I efforts.
And they backed it up with real money, an initial $25 million commitment.
Yeah, the $25 million sends a signal it's not just window dressing. But, beyond the big institute, the source material also mentions some really specific ground-level actions, like grants to minority-owned banks and even financial help for 2,000 street vendors in New York City.
Street vendors, wow, that's specific.
Right, a group totally devastated by the lockdowns and often completely overlooked. It shows they were thinking broadly about community impact.
And education, too. They launched that big scholarship program, full rides for 60 students at 3 major HBCUs, Howard, Morehouse, and Spelman.
A serious investment in building a pipeline of future talent and opportunity.
Okay, so looking ahead now, they've done these huge deals, they've embedded these new values. What are the big goals now? Why are they so confident about entering what they call a growth phase?
Well, it really comes down to scale and reach. Putting their wealth management together with E-Trade and investment management with Eaton Vance. Suddenly, they have this enormous platform managing over $5 trillion in client assets combined.
$5 trillion, that catapulted them, didn't it?
Oh, yeah. They went from being, a top investment bank to suddenly being one of the top 3 players across major individual investor markets, almost overnight.
And it wasn't just acquired growth. Their existing wealth management business still pulled in $175 billion in net new assets during 2020.
Right, which shows that even with all the craziness, clients were still bringing them new money, trusting them.
So what are the targets for this bigger integrated firm?
They're pretty ambitious, that ROTCE metric we talked about. Yeah. The long-term goal is now to get it above 17%.
Above 17. Wow, okay.
Yeah, and they're aiming to get their expenses under control too, targeting an efficiency ratio below 70% long-term. And maybe the clearest signal of confidence. Once they got the regulatory green light, they announced a massive $10 billion share buyback program for 2021.
Bringing buybacks back, but from a position of strength this time.
Exactly. But beyond the pure financials, the other huge piece of their forward strategy is climate, environmental sustainability. It's now directly linked to how they allocate capital.
How so? What's the big commitment there?
They've set a hard target. Reach net zero financed emissions by 2050.
Okay, financed emissions. Break that down for us. What does that actually mean they have to do?
It means they're not just looking at the carbon footprint of their own buildings or travel. They're looking at the emissions generated by the companies they lend money to or invest in. It's about the climate impact of their portfolio.
That sounds complicated to measure.
It is, which is why it's significant they were the first big U.S. bank to join the Partnership for Carbon Accounting Financials, PCAF. They're actually on the steering committee, helping to create the global standards for how banks measure and report these financed emissions.
So they're helping write the rules for the rest of the industry.
Pretty much. And this isn't entirely new for them philosophically. Even before that 2050 pledge, they said 79% of their investment management's long-term assets were already managed, factoring in ESG, environmental, social, governance considerations in 2020.
So the shift was already well underway.
But the net zero target really cements it as a core part of their future strategy. It's a fundamental change in how they see their role. #tag outro.
So wrapping this up, it's quite a narrative, isn't it? A major firm weathering an immense storm, accelerating its digital transformation, and simultaneously embedding these deep changes in values and purpose. Two big takeaways really stand out for me.
Yeah, I think the first one is that their resilience wasn't just luck. It was built on years of investing in that digital infrastructure, which could handle the volume, plus that really quick, decisive action on capital pausing the buybacks. They bought themselves stability.
Right. Financial discipline created operational certainty. And the second takeaway
Is that the specific events of 2020, the pandemic, the social justice reckoning, they weren't just things they reacted to. They triggered permanent strategic shifts. You see that formal commitment to diversity and inclusion and this really clear long-term focus on managing climate risks through their financing.
These weren't temporary fixes. They were structural changes.
Exactly. So the core learning, I think, for you listening is how this high-performing organization navigated extreme volatility. They didn't just survive, they actually accelerated their strategic plans by weaving together social commitment with digital power. They essentially chose to redefine what success looked like beyond just the profit number.
Which brings us to a final thought. We heard about their huge asset management scale, their top-rated funds, generating strong returns. But now we live in this world where ESG factors are increasingly critical and trading is hyper-efficient, automated. So does the future of finance depend more on the sheer speed of the machine, the algorithm? Or does it hinge more on the ethical judgment, the deep analysis of the human advisor navigating these complex new risks and values?
Yeah, what is the ultimate metric of success going to be in the next 10 years? Speed or ethics, automation or insight? Something to think about.